Hi everyone, good afternoon and welcome to today's episode of Modesty's Property Corner. This is season 1 episode number 40. This is a landmark episode for me though because this is the 40th episode of our Modesty's Property Corner. It used to be Modesty's Mortgage Masterclass, but then we moved it to the platform, to our Modesty's Property Corner platform. And it's the landmark for us, the 40th episode since it moved to Modesty's Property Corner, and I hope the last 39 episodes have been useful to you. Otherwise, I must have been wasting my time for 39 episodes. But you know what? Even if it's one person or two that I've been able to benefit from any of these episodes, it really gives me so much joy. And that's why I keep coming here every week, because I know that there are people out there who have questions that they want to be answered, and they don't get the opportunity every week to get someone to talk to them about things that matter to them as far as properties are concerned. And I'm not just talking about properties, I talk about property and property related matters, including mortgages, life insurance and everything you can think of, because I'm a qualified mortgage advisor, and I don't offer mortgage advice on this platform because I'm a qualified mortgage advisor with Independent Mortgage and Loan Company, who are our mortgage partners as far as Modesty's Property Consultants is concerned. Okay, so today, on this landmark episode, I've come to answer a question that a lot of people have been asking me recently, and I've been answering that question individually. But it's kind of occurred to me that, look, not just these people who are looking for these answers, there are also other people out there who are interested in getting this answer. If you live in the UK at the moment, you won't be a stranger to what the economic environment in the UK looks like. And that economic environment is not just limited to the UK, actually. Globally, there is, some level of economic uncertainty. There is some level of economic worry. There is some level of, if inflation is a global thing now, rising cost of living is a global thing now. There are certain factors that have affected not just the UK economy, but also the global economy, especially post-pandemic. So people are beginning to adjust to life post-pandemic. The impact of certain financial and economic decisions that were made during the pandemic are beginning to have its effect and impact on the economies, including the UK. And the property industry is not detached completely from the economy. Although during the pandemic, the property industry was behaving as if it was completely detached from the economy, because it wasn't even following the norm. It wasn't following the usual cycle of, if the economy is down, property market is down. During pandemic, the economy was down, but the property market kept on booming because of certain factors and interventions that helped it. So now, things have completely changed, and things are completely different from what they were in the pandemic. So post-pandemic, a lot of economic factors have come to play that have changed the economic landscape. The property industry is beginning to feel the impact of that change. And the property industry thrives on the actors in that industry. And those actors consist of the buyers, of the sellers, of the renters, of the landlords, of the mortgage lenders, what have you, in the property market and the industry. So people are now looking for an answer to say, as the UK property is now, and the economy, the way the economy is now, and with current trends and recent trends in the economy, is it a good time to buy a property now, or should I just wait? So these questions have been coming, and people who are asking these questions have a genuine concern. There's a genuine reason they're asking these questions, because they are all, the one common thing is that they are all aware of what's going on in the economy. Inflation is running away. High cost of living. There's a cost of living crisis in the UK. Mortgage interest rates are on the rise. Nobody knows what the Bank of England is going to do tomorrow, whether they're going to continue raising rates or they're going to stop, and nobody knows how far they are willing to go to do that. There is the war in Ukraine, which is impacting on energy and food crisis and driving inflation. There is the rising house price increases and house price inflation as well. Nobody knows whether the price of houses in the UK will keep on rising or whether they are about to fall. So all these uncertainties and all these worries is what has triggered the question that people are asking now. Should I buy property now or should I wait? So in answering that question, all I can do is not to give you a yes or no answer. All I can do is to give you some form of indication of what is happening in the market, the current market trends, and certain factors that you need to consider. And then you now apply these things and this knowledge to your individual circumstances and decide for yourself whether it is the right time to buy or not. The idea is to help you make an informed decision. Because if you have the information at your disposal, if you have the knowledge at your disposal, the decision making becomes easier for you, because then you can put one and two together and adapt it to your individual circumstance. Because if I say yes, you should buy now, your circumstance might differ from the circumstance of the next person watching and listening. And that person might take that advice and then go and make that decision, and it might not be in their best interest or their favor. So the best thing for us to do is to offer what we have in terms of knowledge and information that we have, and then say these are the factors, these are the current market trends, these are the things you need to consider. If all that, if they tick your boxes, then it's an indication for you to go ahead. If they don't tick your boxes, then it means that it may not be the right time for you to buy. So the decision will ultimately be yours. So number one thing that you need that I need to address here is, why are you buying? Yeah. So it's a question of, why are you buying? What is the reason? What is the purpose of your decision to buy a property? So are you buying the property for residential purposes? Are you buying the property for investment purposes? This is very critical. Yeah. Hello, Okafor. Sorry, I cannot bring you live onto the video. I hope you enjoy watching, but I can't bring you live so that other people can also take part in what we are saying. So I'm sorry about that, Okafor. Yeah. Now, why are you buying? Are you buying for residential? Or are you buying for investment purposes? This is very critical in deciding whether this is a good time to buy or not, because the circumstances surrounding somebody buying for residential purposes and somebody buying for investment purposes are not the same. Their considerations are not the same. Their motivations are not the same. So you cannot lump all that into one answer and say, yes, the property market encourages you to buy, or the property market discourages you to buy. Because if you're buying for investment purposes, the things you're looking for in a property will be different. The things you're going to be considering will be different. So rather than considering comfort, if you're investing, you're considering viability and profitability. And the parameter of measuring viability and profitability for somebody who is buying for investment purposes is not the same parameter for somebody buying for a residential purpose. Maybe the person buying for a residential purpose, the motivation is, I want a property with an outdoor space, or I want a property closer to work, I want something cheaper that I can afford to pay over a period of time, or I want more space because of a growing family. So those are different considerations for somebody who is buying for a residential purpose. But for somebody who is buying for investment purpose, it's a different consideration, because to that person, it's about, can the rent, pay for this? And if the rent can pay for this, how can I increase the rent in the future if it proves to be not so viable? Can I put down the deposit required to buy this property? How much can I get in interest rates, interest only? For people who are buying for investment purpose, they might want to buy the property on interest only. For those who are buying for residential purposes, they want to buy the property probably and most importantly on repayment, because they want to be mortgage free at the end of the mortgage term. So you can see the stark difference in considerations and situations and factors surrounding the people who are buying. So while you want to decide whether it's a good time for you to buy, your situation, it will be different if you're buying for investment than from the person who is buying for residential purpose. So if you're buying for residential purposes, what you'll be thinking and what you'll be considering will be different. So as I go through the things you need to be considering, and as I go through the market trends, you can now be putting one and two together depending on where you fall within that category, whether you're buying for investments or whether you're buying for residential purposes. I think what I need to do is to basically separate this topic between should I buy for investment now or wait, or should I buy for residential now or wait? Because we haven't got enough time on this program to really delve into these two forms of buyers and be able to do justice to what sort of information each category of buyer needs. But I just want you to grab as much as you can here. Maybe in the subsequent series, I am going to kind of separate it and separate the residential buyer from the investment buyer, and then deliver a session that suits the two different categories of buyers. But that's what you need to consider first. Are you buying for residential? Okay, somebody is asking me to do investment. All right. Okay, so that's a request. I'm going to honor that request, but not in this session. Yeah, I'm going to devote one session to helping investment buyers to decide whether it's a good time to buy for investment, what they need to consider, and what's not. So we're going to do a little bit of both today, but then I'm going to devote more time to the investment session. So thank you very much, Wills and Wigs. That's a promise. I'm going to keep that. The second thing you need to consider in deciding whether this is a good time to buy or not is, what is the opportunity costs of not buying? What's the opportunity cost of not buying? So if I decide now not to buy this property, what other option do I have? For example, if you are an investor and you have this money to invest in this property, and you've chosen that this time is not a good time to buy this property for investment, what's the opportunity cost? What are you going to do with that money? Are you going to save it? Are you going to spend it? Or are you going to invest it in something else? So it's very important you consider the options that are available to you apart from buying that property. Yeah, because for investment, property is a real asset. Yeah, real assets are assets that you can actually, buy. And in inflation period like this, what inflation does for assets or to assets is that it makes assets prices to appreciate. Okay, assets, especially real assets, they thrive during inflation. And because they thrive during inflation, a lot of people tend to store their monies or their cash or their currencies in real assets during inflation. Because the truth of the matter is that every single day in inflation, you are losing money. That money in the savings account is losing value. You're getting poorer with monies in the savings account during inflation, because inflation wipes off the value of that currency lying in the savings account. So being cash rich during inflation is really not a good thing. So for somebody who is an investor, you will be thinking, what other thing can I do with this money if I do not invest it in a property, if I don't buy a property now? Do I consider other forms of real assets or other forms of assets where I can put this money? Or do I just save this money in the bank and then hoping that the things I'm looking forward to, they change and they occur the way I'm looking forward to them occurring? And that means you are gambling and taking risk and wanting to see if things turn in your favor. Risk taking is not a bad thing. Calculated risk taking is what we are advising, and not just taking risk for the sake of risking. Okay, for somebody who is buying for residential purposes, the same question: what's the opportunity cost? I mean, are you intending to save that money, until you're ready to buy, until the factors you're looking at are acting in your favor? Or are you looking to invest that money? And if you invest that money, for how long are you going to invest it? And what is the guarantee that that money will grow or will at least remain the same by the time you're ready to buy? Because investment is a long-term thing. So if you know that you cannot put that money in an investment and leave it there for the next 5 years minimum, then there is no point in saying you're investing it, because in the short run, that money could lose value, that investment could depreciate and could lose value, and you could lose it, the capital that you actually invested in there. So if you're looking to buy for residential purposes, investment may not actually be a very viable option for you outside of buying. So you also have to think about the money that you have saved that you want to use to buy this property. If I don't buy this property now, what else can I do with that money? You consider those options available to you, and you see which one of them offers you more value as far as that money is concerned. Now, the third thing that I need to bring to our attention here is, look at the current market trends, right? In deciding whether to buy or not to buy, what are the current market trends? Now, I'm going to give you a few tips on what the market is currently doing. Currently, according to the Halifax House Price Index that was released in October, the average house price in the UK at the moment has fallen 3 times in the last 4 months. Right, the average house price, according to the Halifax House Price Index, the average house price in the UK has fallen 3 times in the last 4 months. So it looks like there is a trend of decreasing house prices generally in the UK. So the trend is that house prices in the UK are beginning to come down, according to the statistics from Halifax. So in the last 4 months, it has fallen 3 times. So the average house price at the moment, according to Halifax, is about £292,598 for the average UK house price. You know, so that represents a drop or a reduction. But the thing is, even with that drop or that reduction, average house prices still remain at a record high in the UK, even with this reduction. It doesn't really mean that the average house price has fallen flat, you know, face down. They still remain at a record high because there was a tremendous increase in house price, you know, during the pandemic. And, you know, even though they started falling now in the last 4 months, they still represent a very high, they're still at a very high level. And let me just give you, you know, put this in context. In the last 12 months, the average UK house has increased by £22,000 in the last 12 months. The average UK house price increase in pounds and sterling is about £22,000. That's just in context. Then in the last 3 years, it has increased by about £60,000. The average UK house price has increased by £60,000 in the last 3 years. So you can see that, you know, saying that currently, as at October statistics, it has fallen 3 times in 4 months, doesn't mean it has come crashing. The reduction is gradual. I think it came down to 8.9% from about 10.1% in September. That is annually. That's the annual figure. So you can see that as of September, the annual house price inflation was at 10.1%. By October, the annual house price has come down to about 8.9%. So, sorry, about 9.8%, not 8.9%. Right? It's gone down to from 9.8%, sorry, I'm mixing this, from 9.8% in September to 8.3% in October. That's the correct figure. From 9.8 in September to 8.3% in October annually. So you can see the margin of that reduction, and it's showing you that the house prices are coming down. Now, the other thing that is also coming down and that has shown a decline in recent times are mortgage rates. Yeah, surprise, surprise, mortgage rates coming down. Hey, what are you talking about? Okay, so let me put that also in the right context. I'm referring to the post mini budget era. The mini budget that was presented by Liz Truss and Kwasi Kwarteng kind of startled the markets, and mortgage interest rates shot up significantly because the markets were shaken by that mini budget. That mini budget was filled with unfunded tax cuts that the UK government lost credibility in the eyes of the world and the financial markets, and it kind of almost sent the UK economy tumbling. So now, with the reversal of virtually everything that was in that mini budget, the market is beginning to stabilize a little bit again. But stabilizing, that means that it's beginning to come down. A lot of lenders are beginning to reduce their interest rates because the confidence has returned again to the government and to the UK market, and therefore lenders are responding positively to that and beginning to reduce their interest rates. So it's no longer as crazy as it used to be after the mini budget was announced. So that's one thing that is also on the decline. But the other thing about annual price growth, about mortgage approvals and demand, Halifax House Price Index showed that mortgage approvals and mortgage demand is also on the decline. What it simply means that less and less people are applying for mortgages, and less mortgages are being approved. Now, with mortgage approvals, it could be because affordability has been stretched and affordability criteria has been made more difficult. At this moment in time, that not a lot of people are meeting the affordability criteria because lenders are beginning to tighten up the affordability criteria because of the economy. And less and less people are being put off from applying for mortgages because of the high rate of mortgages in the market at the moment. And an average 2 and 5 year fixed rate mortgage at this moment in time is ranging between 5 to 6 point something %. That's crazy, isn't it? But then you have to look at what the Bank of England is doing. The Bank of England has, they raised the base rate from 2.25% to 3, all the way to 3%. That is 0.75%. That's the highest level of increase since I think 2008 or thereabout. So that's the highest rate it's gone up by, and that simply means that lenders have to build that and factor that into their rates. So we're seeing rates of between 5 and 6% for average 2 and 5 year fixed rate mortgages in the market at the moment. So it's not surprising that demand for mortgages are falling because high cost of living, right, with inflation, okay, and that high cost of living and inflation are driven by the war in Ukraine and shortage in supply of raw materials and shortage in supply of goods. All these things put together are making people take a step back from buying property, and that's affecting the demand for mortgages. And because lenders are tightening their criteria, their affordability criteria, it's also affecting how much mortgages they are approving at the moment. So mortgage interest rates are dropping, but it doesn't mean that mortgages are becoming easier to get at the moment because of the tightening criteria by the lenders. Now, tomorrow we are going to hear from the current chancellor about the autumn statement. And already, it's not something that a lot of people are looking forward to, because the autumn statement is expected to deliver, some financial and economic uppercuts, especially to some families, because it's expected to deliver higher taxes and spending cuts. So the government is going to take a seat back. Sorry, somebody's asking a question. What is the rate of tax paid for property investment for someone who wants to invest in the property market? Okay, the rate of tax for property investment there is no flat rate of tax for property investment, there are different ways your property investment could be taxed. You know, if you're investing through a limited company, you'll be paying the corporation tax based on what you have earned from that property investment. If you're investing in your personal name, you'll be paying income tax based on your income from that property. But then you have to pay your stamp duty land tax as well, because that's a compulsory tax payable by anyone who is buying a property. So there is no, and at the moment, going by the current changes, from next year, corporation tax is going to be higher than income tax. So those who are buying in company names might end up paying more in corporation tax, and those who are buying individual names might end up paying less in income tax. But then if you take out income from that your property company, you're going to have to pay tax in two places. So you're going to pay a corporation tax and income tax from the income you have drawn from that property investment. But hey, today it's not about talking about property taxation and all. I just wanted to, answer that question. Olarewoja, I hope that answers your question. Now, coming to the autumn statement tomorrow. That autumn statement is going to deliver some bad news, unfortunately. Nobody likes to hear about tax increases. Nobody wants to hear about spending cuts. It simply means things are going to get tougher. People are going to see less and less of government money. Government is going to spend less and less money on, public services. It means people are going to have to pay more taxes. And paying more taxes when cost of living is really biting, when mortgage rates are rising, when inflation is rising, it's not the best form of economic concoction that anybody wants to drink at this moment in time. It's not the best of economic cocktails that the government can prepare, because it just does not excite anybody. Okay, so I'm just talking about the current trends. These are the things that the economy is delivering at the moment. So we've talked about inflation, we've talked about interest rates, we've talked about, things that are driving market prices. Why are property prices increasing? Property prices were increasing because there was too much demand and there was shortage of supply. Now property prices are dropping. Property prices are dropping because the demand is slowing down. People are beginning to take a step back from buying properties because they are considering the affordability and the viability of that property purchase. If they cannot afford it, if they don't see it as very viable, they'll take a step back and say, hang on a minute, we can't afford to pay this much in mortgage every month because we just cannot afford it. You cannot buy a property that you cannot afford, right? So affordability is a very, very big issue, which brings me to the next thing that I want you to consider when you're looking to buy a property, to decide whether this is the right moment to buy or not. Affordability and viability. That property you want to buy, can you really afford it? And not just being able to afford it at this moment in time, can you afford it going forward? Sustainability of that affordability is very important, because you are taking a mortgage for maybe a long-term mortgage, 15, 20, 25, 30 years or even more. Right? So you're expected to be consistently paying that mortgage. Now, there's something called stress test or stress testing, right? If the lenders stress test your mortgage, say if they are giving you a mortgage of 5.5%, they might decide to stress test that mortgage at, say, 8%. To see if you can afford it. What they are simply saying is that if mortgage rates rise to 8%, can you still afford it? If you pass that stress test, the lenders can afford to lend you that money. And that is a stress that you don't even need the lenders to do for you. You can do it yourself, to say, if I take this thing now, and by the time my mortgage is coming to an end, say I take a 2-year fixed, in 2 years' time, if rates have gone up to 8%, can I still afford that mortgage? So those are things you need to consider: affordability and viability. If you can afford it now, can you still afford it going forward? If the answer is yes, then you can go ahead and buy the property, because it means you can afford it now, even if interest rates rise. But if interest rates rise and you cannot afford it, you stand the risk of having that property repossessed. So, guys, this is where we are going to hang it up today. I hope this has been useful to you guys. I know it may not be the straightforward answers you've been waiting or you're looking for, but I think laying these things before you will help you make an informed decision. And for that informed decision that you've been able to make, thank you so very much for joining in, and thank you so very much